100% bonus means 1 to 1,000 leverage. Let me show you guys how 100% bonus is maybe killing your account and how to use lower leverage as a new trader, what a spread means, and finally, what does it mean to buy and what does it mean to sell. Leverage is buying power. How much leverage can you have? 1 to 100, 1 to 500, 1 to 1,000, 1 to 2,000, and then obviously some brokers offering unlimited leverage. What is that and what does it mean? So leverage is how much buying power do you have on your account. If you have a $100 account and you have a 1 to 100 leverage, it means you can trade with $100 in a sense. If you have a 1 to 500 leverage, then you can trade with 5 times your account. So you have a $100 account, you can trade as if you have $500 in your account. So 100% bonus, obviously you guys have seen multiple brokers offer 100% bonus. It's just a leverage act. They push your leverage up 1 to 1,000. So it does seem like you have 100% bonus, but it's just obviously 1 to 1,000 leverage. Then we have 200% bonus, which is 1 to 2,000 leverage. So is leverage a good thing? Should you have high leverage, low leverage? So leverage is an important key factor that will make or break most traders. So for me, this is just my opinion. For a new trader, when I started trading, we only had 1 to 100 leverage, which I think saved me a lot. Obviously, we didn't have indices, and we also didn't have higher leverage and bonuses and all those things. So leverage is a good tool if you know how to use it. So I will do a full video on leverage trading for you guys and explain to you guys how to use leverage. But for you as a new trader, I mean, if you're doing this course, you're most probably a new trader or not profitable yet. So that means you should be having a lower leverage. We obviously start everyone at raise with 1 to 100 leverage, and that is to protect your account. Yes, more trading with $500 as if you have $100 seems like a good idea, but also it means you're going to blow your account faster. So rather have more opportunities to trade than just blow your account with one go. So a lot of you guys keep funding your account with $100 and then blow it once, $50, blow it once. Rather than just trading with $100, 1 to 100 leverage, trading on 1 cent and learning and understanding consistency first. Because if you're consistent, then you'll understand that leverage shouldn't be a thing. So you should never have one account. If you're only trading on one account, high leverage is not your go-to. High leverage is used when you try to do account flipping. What account flipping once again is if you put in $100 and you're going to trade a news event, or if you're going to trade one trade, so you have like $1,000 and you break it up into $100 accounts. That's when you want high leverage, because you obviously want to leverage your account. But having one account and having a 1 to 2,000 unlimited leverage is really not a good idea. So let's get into the market and let me show you guys how you can actually trade and how you can use different leverages and what does it mean on your account. Alright, so you get different leverages. So let's start with a $100 account. So it's the easiest to explain. So let's say you have $100 in your account. Once again, I'm always going to be using $100 because if you're trading with less than $100, it's really difficult to actually build a trading career and obviously build consistency, because if you can't use risk management, there's no way you're going to ever get funded or get to a big account because you don't understand consistency. So I always start with $100. So if you're trading on a $100 account, my advice will always be to trade on a 1 cent. If you're trading bigger than a 1 cent, your path will be really long once again. Although you guys see all these people trading with 1 cent, and we always see these memes that says that the 1 cent won't get you the BMW or whatever it might be, and yes, that is true, but what 1 cent will give you is consistency. What consistency will give you is account growth. What account growth will give you is access to funded accounts, to all those type of things. And that's why I truly believe most traders fail, is they look at social media traders or Instagram traders, whatever it is, and they just believe that these guys just started on 10 lot size, or in South Africa 10,000 lot size. But in general, most of us, well, all of us that actually do trade started on a 1 cent. That is a fact. Especially if you're in South Africa, we don't have the $1,000 to fund or $2,000 always to fund. So it's really important to start with something that you are good at and obviously can help you with good risk management. So let's look at this USD trade. I'm not going to do a full run through of why the trade played out. It's really simple. Break of structure already there. High, 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 low, triple bottom. Really, really simple trade over there. Obviously with the dollar index dropping as well. So if you're going to be taking this trade, there's multiple ways to determine your stop loss. Number one would be obviously, so stop loss we will still do a full lesson on. So they will see the 61 fib and we'll put our stop loss below the 71 fib. So we're looking at about a 300 point or a 30 pip stop loss. Okay, so 300 points, 30 pip stop loss. Okay, I'm going to put both in. Obviously some of you guys, everyone learns different. So if you use a 1 cent and you have a 300 point or 30 pip stop loss, that means 300 points times 0.01 will equal $3. So you will be risking $3 on this specific position. So we'll also do a full risk management video as well. But if you enter with a 1 cent, then you are using, and you have 1 to 100 leverage. Okay, that means you are using 10% of your leverage. Okay, so on a 1 to 100 leverage, your max lot size is 0.10. Okay, so let's say you do put the full 10 cent in this specific trade. That means that you can go all the way into 1,000 points, 100 pips into negative before you blow your account. Okay, so once again, it's a 50-50. You don't want that. You want 10 opportunities before you blow your account, because in reality, traders don't win 100% of the time. Once again, it's just people selling robots in South Africa that wins 100% of the time. But in reality, no one wins 100% of the time. So what you then do is, if you push your leverage up 1 to 500, that means that you're now trading as if you have $500. Okay, so it's just a thing of boosting your leverage, boosting your buying power, and that means we can now enter with 0.5 lot size. So if we look at this specific position, let's say we did use a 10 cent, price went up 2,069 points or 200 pips. So we would have made $200 on a 10 cent lot size. So on a 50 cent lot size, we'll be making $1,000. But once again, where do you blow your account? Over there. So 20 points or 200 pips, you will be blowing your account. So already you're cutting the margins fine, and that's why I said to you guys, I will do a full leverage trading video, but we're only going to use that when we do account flipping, because account flipping, you know, you're going to be risking that $100, but you can make $1,000. And if you're wrong, then obviously you have another $100, and that's obviously how you keep going it. Now, if you have 100% bonus, or you have a 1 to 1,000 leverage, that means that you now have $1,000 buying power, and that means that you can trade a full 1 lot size. Okay, so 1.00. So once again, it seems great because now you have all this buying power. Although you don't have the money, you have all this buying power, but that will lead you to blow your account on a 10 points or 10 pips or 100 points stop loss. So doesn't matter how good your entry was, you would have hit stop loss on this specific position. Even if you took that entry over there, which is at the bottom, you'll blow your account. So this is something that I'm going to leave you guys with. I can almost write you a letter and tell you that it's going to be like that most people trading with bonus accounts, if you look at a broker with normal leverage, you'll see the success rate currently is sitting at 78.6. I'm not making it up. It's a fact that we put on our website. We need to put it through due to compliance reasons. But if you look at a broker offering 100% bonus, 200% bonus, they'll never add those stats to their website, because most people trading with 100% bonus accounts, I'm pretty sure that the success rate is at 4% at that specific account type. So in the end, we don't always see it, and obviously it's the second part is just what I'm thinking due to knowledge within the market. So I really suggest start with a low leverage, build yourself up, build your confidence up, and build your consistency up, and then later on, when you know what you're doing and you know how to trade, then focus on using a high leverage and capitalizing on a high leverage. and swaps and commissions. So a broker is the middleman between yourself and the market. If you, for example, want life insurance or anything, you get a broker. So that broker is the exact same as a Forex broker. They charge a spread fee. So the spread fee is in a way an entry to barrier. So if you, a barrier to entry, if you want to enter the market, you're going to pay a certain spread fee. So let me quickly explain to you guys how to use spread fees, because or how spread fees work, because it's really important to calculate spread into your trade when you're placing a stop loss. Right guys, so then it is very simple. We're working with spread. So you get the bid price, which is the first price, you get the ask price. So the bid price is the actual market price. The ask price is the broker price. So the difference between those two is the spread. So I still see people in this day and age still complaining about spread. But the one thing that I'm going to be telling you guys is spread is always going to be there. It's not something that's going to go away. It's not something that is being implemented today. And a real trader, you'll never hear a real trader complain about spread. Obviously if it's normal, not if it's extremely high, and I will get into what is extremely high. So it's really important to understand there is a difference, and there's always going to be spread. And the reason spread is important to understand is the higher the spread, the bigger the stop loss. That's what I'm about to say. So if you have, for example, if you know your stop loss should be 300 points or 30 pips and the spread is 20 points, then you need to put your stop loss on 321 or 322, because you need to adjust your thing for the spread, because it's always going to be there. So if you guys look at your USD, for example, on this specific on RaiseFX, so at the moment it would seem like it's higher, and the reason for that is it's the market close. So which is a really important fact. A lot of you guys don't understand that when this 11 o'clock changeover happens at night, the spread pulls open. Doesn't matter. I can tell you guys, I've traded with probably 100 different brokers in the past 8 years. The spread pulls open on any broker in the world. Okay, at 11 o'clock a lot of volume goes out of the market, and that causes volatility, causing spread to pull open. When there's a news event, spread pulls open. It's not your broker scamming you, manipulating the market. That's the reality of trading. And once again, so many traders are so uneducated about spread that they always run to, once they lose, they always run to the thing of I was manipulated or anything. So if you enter just before the news and you over leverage, and all of a sudden the spread pulls open, then you get stopped out because of the spread. Remember, the spread is actually then the price, because the spread is the actual market price. So the spread then pulls open, margin calls you, and then you say the broker manipulated you. But actually it's just how the market works. And once again, why leverage is not always the biggest thing and the best thing. So you guys will see here on USD in this instance, it will say 6, 7, and 8, 6. So it's going to be 3, 13 plus 6, so 19 points or 1.9 pips. That means if you're entering on a full one lot size, you're going to be paying $19. If you're going to be entering on a 10-cent lot size, you're going to be paying $1.9. If you are entering on 1 cent, then you're going to be paying 19 cents. So obviously the higher the lot size, the more spread you pay, because obviously the more exposure you're pushing into the market. So the blue line is the actual market price, the red line is the broker price, which is the spread price. So it's really important to cater for that. And then once again, do yourself a favor, don't complain if spread is low. I mean, on USD, anything, I'll say anything below 20 pips, 2 pips or 20 points is really good spread. We'll see that most local brokers range in 36 to 40. So if you get somewhere close to 20 even, it's a really good spread, and really good trading conditions. You get selling and you get buying. So you don't physically sell or buy a product. So it's not like Bitcoin where you physically own a product. But selling means you're betting on price to go to a downside. Buying means betting on price to go to a top side. I know betting doesn't sound like a good word, because then it seems like we're gambling. But in the end, obviously, Forex is calculated, and there is a lot of ways we can be profitable through patterns and all that. It's just a word that I use. But selling means you're thinking the market's going to go down. Buying means you're thinking the market's going to go up. So let me show you guys what is the difference between selling and buying. Right guys, so now finally selling and buying. So we'll see on our MetaTrader we have two buttons, sell or buy. Sell means you are betting on the market to go to the downside. Once again, betting is probably a bad word, but that's how it works. So if you look at USD, for example, let's say we do have this big area of support over here, so we could see price keeps going up from that level. So let's say you bought over there, okay? So if you bought at this specific price over there, anything up, anything above that is profits. So the market moves 140 points up or 14 pips, that means you're 140 points in profits. So anything to the downside is obviously losses. So a lot of people panic when they go into losses, and that's why, once again, risk management is the key factor to managing your emotions when it gets to trading. So if you take a buy, anything above your buy is going to be profits, and if you take a sell, okay, then let's say you take a short position at current price, okay? So Monday, if the price goes below that level, then obviously you're going to be in profits, and then if price goes to the top side, then you're going to be in negative. The reason you obviously calculate your risk, because a lot of traders will obviously panic, get out of the market when they go into negative, and that's why you should have a stop loss, number one, and number two, trust your stop loss, because most traders will exit the market once they go into negative, and then you'll come back the next day and you'll see the move actually played out. So it's really important to trust and understand your levels and stick to your predictions. Thanks for everyone just watching and supporting. I really do appreciate all the support, and then I'll see you guys on the next one.